Hey, have you looked at your grocery bills lately? If you haven't, take a look because you're gonna see inflation is kicking back. It's been like what, 18 months now that we are on that temporary inflation period. Today, we are going to look at inflation. We're going to look at how you can protect your portfolio because if you don't, you're going to suffer. My name is Mike Roux. I'm the founder of Dividend Stocks Rocks and I am a passionate investor. Welcome to this YouTube channel where I help people to invest with more conviction so they can enjoy their retirement. And speaking of which, once you have built your portfolio and you're about to retire, you want to generate some income from it, and your worst enemy is probably the inflation. As you can see, both in Canada and in the US, it has been a while since we haven't seen that much inflation. We're talking about 7% in the US, close to 5% in Canada. This is also a situation where it's probably worse for many of us because the inflation as it is being provided by central banks is based on a basket of goods. In that basket of goods, you will find tobacco, you will find rent, you will find technology, automobile, apparels. You're going to find all kind of stuff. But as a father of three, my largest expense every month is definitely food. And if you look at food prices these days, it's just crazy. It's definitely more than 5-6%. We're probably going to talk double-digit inflation. Inflation has a huge impact on your portfolio. First, it has an impact on companies. Obviously, it will put some pressure on margin because you have cost of raw material rising, wages rising. There are fierce competition in some sectors, so companies are already battling into a price war, and now margins are getting squeezed. And sometimes worse could happen is sales slow down. There's a limit of consumers' budget to spend on apparel, on Nike shoes, on pretty much everything. So at one point, the consumer would just say, you know what, I'm going to slow down and I'm not going to make those purchases right away. And for those reasons, those companies should have a hard time. So inflation at retirement is bit of a pain. If you look at creating your own made dividend, meaning that you intend to sell some ETF or some shares to generate your income, well, during high inflation period, the stock market is not at its best. So probably that the stock prices are going to go sideways, are going to drop. So it will affect your ability to generate income from your portfolio. And if you are counting on those generous dividends, well, think again. The companies that don't increase their dividend payment year after year are actually doing a passive dividend cut, because if inflation goes up by 4 or 5% and your dividend is not increasing, well, you're losing buying power every single year. Today, it's not going to make a big difference. In 10 years, trust me, that restaurant that you like to have dinner with your friends, going to be very expensive. Made some research to know what would be the best protection for inflation. The first one that's seen in the 70s, and everybody will be thinking about that, it's gold, right? However, if you look at this graph was created by Morningstar, and very interestingly, during the other two periods of high inflation in the 80s, we see that gold didn't do much. We're going to talk about other asset class in a second, but I want to show you exactly what happened over the past 10 years. So between 2010 and 2020, on this graph, what you see is the consumer pricing index for Canada and the US, which is pretty much going towards the top all the time, like slow but steady. And then you got the gold price in red, which is goes up and down and up and down and up and down. So I'm not going to tell you not to invest in gold. I've already done that in a previous video. So go in the link description below. I'm going to show you how gold is not a big protection in your portfolio, but it's definitely not a steady protection against inflation. Actually, there's not really correlation on this graph over the past 10 years. So from some periods, it's going to work out. Some others, it's not going to work out. So I would not necessarily count on gold for that. Actually, gold is only good if there's a lot of panic in the stock market, and it's only good for a very short period of time. So if you're just patient enough and you don't look at your portfolio when it crashes, and you hold on to your great companies, especially dividend growers, if you wait a few years, you're not going to feel it. and then the gold protection will be kind of useless. Now, back to the solution. There are other sectors that will do well in a high inflation environment. One of the first one that you can think that is obvious and has been rolling is commodities. So we can thinking of lumber, we can think of like metals, and most importantly, oil and gas. They are at the basic of the foundation of inflation, basically, because if demand increase, price will increase for that, and those producers will just pass the inflation to their customers. They have run into a huge bull market since the end of 2020, so kudos to you if you just pick that up at that time. But as you know, they are quite volatile, so they're not my favorite sector if I want protection against inflation. I rather focus on REITs, utilities, and consumer staples with strong pricing power. Why? Because all of those three are able to pass inflation to their tenants and to their customers. Especially for REITs and utilities, they already have long-term contract, including escalation rate. So they already know in advance that they will be protected and the revenue is going to increase along the inflation. Finally, dividend growers, and we're going to talk about that later on in this video, so stay tuned. I want to show you something first, though, is it's not because you select companies from great sectors that you're going to actually be successful. On this graph, you see Macerich, which is still about not dying yet, so it's still there. Macerich is a REIT in the retail business, Vermilion Energy in the oil and gas business, Suburban Propane, oil and gas as well, and then British American Tobacco for consumer staples. All of them didn't do that much good over the past 5 years. So you have to improve your research and be maybe a little pickier with your metrics. In order to do that, at DSR, we have created the most powerful dividend screener. So we searched through 1,100 stocks, both on Canadian and US markets, and then you can apply a bunch of filters and search through 40 financial metrics, including an ESG score, a value score, credit, prorating, dividend safety. So you'll be able to find the best stocks that will actually fight the inflation. So we're going to take a pause right now and we're going to go back to DSR and see how you can actually do that. All right, so now we are back on Dividend Stocks Rock. I'm using this tool because I've built it, and I've built it because I wanted to have something that is tailored to my needs. Obviously, you can try to replicate this type of search with free stock screener, maybe from your brokerage account or maybe from Finviz. Sometimes it will not be perfect, but you know, this is better than nothing. So here we go into the analysis page. So we're going to look at the stock screener at Dividend Stocks Rock. The stock screener covers over 1,100 dividend paying stocks on both Canadian and US market, including some ADRs, but not too many. And here I have saved views. So whenever I've built a stock screener with different types of metrics that I want to like, different types of filters, I can save it. So I have like a bunch of them that are saved, and I have a special one called inflation. What a surprise, right? So with this one in mind, we're going to look at the columns that I've selected. So basically, I want to have the sector, that's obvious, and then prorating and dividend safety score. Those are two metrics that are exclusive to Dividend Stocks Rocks that will tell you if it's a buy or a sell, and it will tell you if the dividend is safe or not. Then we look at the dividend triangle, so revenue growth, earning growth, and dividend growth. So in this field, I have the EPS over the past 5 years, revenue over the past 5 years, dividend over the past 5 years, and 3 years. On top of that, I've also added the Chowder rule, which will add the dividend and the dividend growth to see if we're getting a good score. So pretty much anything that is above 8 or 9 should be good, depending on the sector and depending on the industry. Now, in terms of filter, what I've done right here is I've selected all market, but I could go for Canadian or US exclusively, and I've also selected all the sectors. But I could again decide that I just want to have the REITs. I can go with materials, I can go with energy or utilities. Those are common sectors that will protect you against inflation, as I discussed. Prorating minimum of 3, dividend safety score minimum of 3 as well. So I want to make sure that I only have great companies that will be filtered in this process. And finally, I want companies that shows earnings that will be positive over the past 5 years. Revenue, same thing, and a dividend growth of at least 3. Why 3? Because I want to make sure that I protect my money against inflation, right? That's the whole purpose here. I could have put some payout ratios or PE ratios, minimum or maximum. I can go in terms of advanced filter also to look into some specific industries. Dividend frequency, so if you want to be paid monthly, for example, that could be interesting. Then other types of metrics are also available, such as the credit score, the value score, or Chandler rule to have a minimum and maximum as well. And let's not forget the ESG score at the same time. So once I have built that portfolio, that list of stocks, right now I have maybe a little bit too much. We are at 285 that correspond to those metrics. So it could be interesting to narrow it down, but at least you get a good start. So the purpose here is to identify companies that will show a thriving business and some dividend growth potential. If you're looking for a little bit more income, another one that could be interesting in the filter would be the dividend yield. So let's put the dividend yield minimum of, let's say, 3, just for fun. And now we're going to cut down the list to, roll drum please, 85. So you can see, then you can search by sector to make sure that you find the great stock that would fit within your portfolio, and you're good to go. So now let's back on how you can manage those companies and why dividend growers are the best pick for your portfolio against that battle against inflation. So now that you have found and built an interesting list of companies in the great sectors that should protect you against inflation, now it's time to go and look at their ratings and make sure that they show some growth perspective, that the potential risks are not too high, and most importantly, that they will protect their dividend. So if you have a rating from 1 to 5, as we have at DSR, showing a dividend safety score, telling you if you have like dividend trash or like bad dividend payers, companies that are not increasing their dividend year after year, you are not protected against inflation. So you must identify those and focus on dividend growers. Why dividend growers? Well, actually, it's kind of very interesting because if you look at the past 50 years, so back into the 70s, you'll notice that dividend growers and dividend initiators, so companies that increase their dividend year after year, they tend to outperform the market. It's not necessarily that they will do it all the time, and it's not guaranteed. The past doesn't guarantee the future, so please do your own due diligence. But in general, companies that are able to grow their dividend is because they're companies that has a lot of growth vectors, that are thriving businesses, strong brand name, good market share, investing in innovation or acquisition so they can even go even further, and they have a robust balance sheet. So as an investor, isn't not the type of companies that you would like to have in your portfolio? Interestingly enough, on top of outperforming the market on a regular basis, they actually do it with less volatility. So in other words, more money in your pockets with less headaches. How about that, right? If I'm about to retire, this is what I want to sign up for. I don't want those companies with the high yield and then it goes up and down and eventually cut down their distribution because they are facing too many challenges. I want thriving businesses that will increase my payment, and so I can beat the inflation and not worry about it. So in summary, if you want to protect your portfolio against inflation, you have to focus on some sectors. You can do it with commodities. Be prepared to run a little bit of a roller coaster, but if you want to protect your portfolio even more, you can go do it with REITs, with utilities, with some consumer staples. Even the financial sector could be good as well. And then pick up dividend growers. Those are probably your best pick for the long run. So speaking about dividend growth, we have created a complete recession-proof workbook. So this is a tool that you can download right below, and this tool will help you to build your portfolio, select the right sector, and also come with a set of metrics and an investment thesis for each of those companies to make sure that your portfolio as a whole is able to not only beat the inflation, but also protect you from potential recession. We kind of like evolve right now in a kind of like weird market where it goes up and down. There's a lot of volatility, there's a lot of nervosity, and a lot of noise. So what you need right now is to clear that noise and get back to something that is simple, that is clear and concise, so you can avoid the noise and you can avoid being paralyzed by analysis. So download the free book right there, and until the next video, stay invested.